Today, we examine what a second Trump presidency could mean for global capitalism and markets worldwide. A Trump 2.0 administration would likely pursue policies significantly different from current approaches, with far-reaching implications for international trade, monetary policy, and economic relationships. Let's start with trade policy. Under a second Trump term, we'd likely see an intensification of the America First agenda. Based on recent statements, Trump has proposed a universal baseline tariff of 10% on nearly all imported goods. This would represent a fundamental shift in American trade policy, moving further away from the post-World War II framework of multilateral free trade agreements. Consider the numbers. The U.S. imported approximately $3.2 trillion worth of goods in 2022. A blanket 10% tariff would generate significant revenue, but would also raise prices for American consumers and likely trigger retaliatory measures from trading partners. Economists estimate this could lead to a 1 to 2% increase in consumer prices across the board. China would remain a central focus. Trump has suggested raising tariffs on Chinese goods to 60% or higher in some cases. This would reshape global supply chains that have taken decades to build. Companies would face increased pressure to relocate manufacturing to either the United States or to friendly nations, a process already underway but likely to accelerate dramatically. In the technology sector, we'd likely see expanded restrictions on Chinese access to advanced semiconductors and other critical technologies. The CHIPS Act would likely be leveraged further to reshape semiconductor manufacturing, with increased incentives for domestic production and stricter controls on exports to China. Looking at monetary policy, Trump has been vocal about his desire to replace Jerome Powell as Federal Reserve Chairman when his term expires in 2026. This could signal a significant shift in U.S. monetary policy. Trump has historically favored low interest rates and has criticized the Fed's recent tightening cycle. A new Fed chair aligned with these views might pursue a more dovish monetary policy, potentially leading to higher inflation, but also supporting asset prices and economic growth in the short term. Energy policy would see perhaps the most dramatic shifts. Trump has pledged to maximize American energy production, particularly fossil fuels. This would likely mean expanded drilling permits, faster pipeline approvals, and reduced environmental regulations. While this could lower energy prices and enhance American energy independence, it would mark a sharp departure from current climate commitments and could affect international climate agreements. The dollar's role as the global reserve currency could face new pressures. Trump has expressed interest in exploring alternatives to the current international monetary system. Any moves to fundamentally alter dollar dominance would have profound implications for global trade and financial markets. The BRICS nations' efforts to create alternative payment systems might find a more receptive audience in Washington. Immigration policy changes would affect labor markets significantly. Stricter immigration controls could exacerbate labor shortages in key sectors, potentially driving up wages but also increasing inflationary pressures. Industries heavily dependent on immigrant labor, such as agriculture, construction, and hospitality, would need to adapt through automation or higher wages. Looking at financial markets, a Trump 2.0 presidency would likely bring both opportunities and risks. Defense contractors might benefit from increased military spending. Traditional energy companies could see regulatory relief. However, renewable energy firms might face headwinds as federal support shifts away from green initiatives. The technology sector could face increased scrutiny, particularly companies with significant Chinese exposure. However, firms focused on reshoring manufacturing or developing domestic supply chains might find new opportunities. The pharmaceutical industry could see pressure on drug pricing, but might benefit from reduced regulatory burdens. International relations would enter new territory. Trump has suggested rethinking America's role in NATO and other international organizations. This could affect defense spending patterns and international trade relationships. Countries might accelerate efforts to reduce dependency on U.S.-dominated financial systems and trade routes. The automotive industry would face particular challenges. Any new tariffs would affect complex international supply chains that have evolved over decades. Electric vehicle manufacturers might see reduced federal support, while traditional automakers might benefit from relaxed fuel efficiency standards. Real estate markets could see significant impacts. Any move toward looser monetary policy could fuel another real estate boom, though this would need to be balanced against inflation risks. Capital markets might experience increased volatility as investors adjust to new policies. The potential for trade conflicts and geopolitical tensions could lead to market disruptions, though some sectors would likely benefit from deregulation and tax policies. Small businesses would face a mixed environment. Access to immigrant labor could become more difficult, affecting industries from agriculture to construction. The banking sector might see significant deregulation, potentially rolling back post-2008 reforms. This could increase profitability, but might also raise systemic risks. Regional banks, in particular, might benefit from reduced regulatory burdens. Global tax policy could shift dramatically. Trump has criticized the global minimum tax agreement and might withdraw U.S. support, affecting multinational corporations' tax planning and potentially triggering a new round of international tax competition. Looking at long-term implications, a Trump 2.0 presidency could accelerate the trend toward deglobalization and regional economic blocs. This might lead to a more fragmented global economy, with distinct spheres of influence centered around major powers. The impact on emerging markets would be significant. Countries heavily dependent on exports to the U.S. might need to diversify their economies and seek new trading partners. This could accelerate the development of regional trade blocs and alternative financial systems. As we conclude, it's essential to note that markets and economies are resilient and adaptable. While policy changes can create short-term disruptions, businesses and investors typically find ways to adapt to new realities. The key will be understanding these potential changes and positioning accordingly. What's clear is that a Trump 2.0 presidency would mark a significant shift in economic policy, affecting everything from trade relationships to monetary policy. The global capitalist system would likely become more fragmented, more nationalist, and potentially more volatile. Understanding these dynamics will be crucial for investors, businesses, and policymakers in the years ahead.
Thanks for watching. If you enjoyed this video, don't forget to hit that thumbs up. It really helps the channel grow. And if you're new here, subscribe and turn on the notification bell so you never miss out on our next adventure. Let us know your thoughts in the comments below. We'd love to hear from you. Until next time, stay awesome and keep exploring.